Hey folks, so I wanted to share one of the trades that we used to capitalize on the recent drawdown in risk assets, particularly the equity markets. And for the most part, what I try to do when it comes to managing risk is I like to express views through something called a credit spread, where basically you sell an option, then you buy an option against it. You can do both bullish or bearish views on that, and the great thing is they're kind of market neutral, so you're not really making a directional call. In this particular example I'm about to show you, though, we actually ended up making a directional call because we had a very high conviction that the market was going to go lower, at least to a degree. So let me flip the camera here. You guys can see what's going on. So what we did here on January 21st, which was this day right here, is we used the Russell 2000 and we sold a credit spread. Specifically we sold the March 165 170 bear call spread, which means that we sold the 165 strike call using March options here in January, right? So it was important to skip a month in our opinion. And then we sold against at the 170 strike call. We took in a net credit of $3.10, which basically translates into $3,100 for 10 options contracts. And the reason why we did the trade is because we saw, first of all, the broader market continue to push higher with just a few stocks. So the low volatility squeeze was very persistent in just a few names like Microsoft and Apple, and a few other names that you can probably guess which they were. And we thought that expressing that quasi-bearish view in the Russell 2000 gave us a higher probability, because the Russell tends to be a little bit more volatile when you get a mean reversion move. And so what we also noticed from a momentum perspective, and this is just another aspect, if you look down here, is that here on the 17th of January, so just a couple days before we put the trade on, the momentum actually looked to make a lower high. And so we kept this trade on even through the little drawdown we had into the second half of January. And then we closed it back on the 26th of January for 68 cents. So basically the profit we made was the difference between the $3,100 we received and the $680 we had to pay to get out, which basically means we made $2,420 for every 10 options contract, which is 121% return on risk. And again, usually we sell out of the money call spreads or put spreads, which would be the bullish version of it. But in this particular case, because the broad market was so extended, we thought there was a good chance of the market actually mean reverting lower. So I just thought I would share with you, what we did. Maybe that's something you can incorporate yourself into your sort of trading and investing strategies. But anyway, hope it helps. See you guys soon.